preparing to go live.
Like a drum roll.
Yeah, give myself a little drum roll. And we are live. All right. Preparing to go live. Okay. So good afternoon, good evening, or good morning, depending on where you're joining us from. Today is the first episode of the AI Circle on YouTube, presented to you by iFlip. I am your host, Aaron Yoon. I am the product manager here at iFlip. And today we have also with us our CIO, Kelly Korshak. Say hi to everybody, Kelly.
Hello, everybody.
So in case you haven't been to one of these before, because we used to hold these internally via Zoom, the way it works is something like this. It's very simple. Kelly, our CIO, is a former hedge fund manager, former trading professional, managed billions of dollars on Wall Street in a previous career, and he presents us with his thoughts on the crazy new world we live in post-COVID and this crazy new market that we're having to deal with. So we're going to get some updates from Kelly Korshak. I'm going to also give you some very minor product updates for today. There's very, very little to talk about today. When there's more significant updates, I'll spend a little bit more time, but for today, it won't take up too much time. And then the real fun is where we get to answer your questions live. So if you're joining us on Zoom, you know what to do. You've been here before. Type it in the chat. Type it in the Q&A section. If you're joining us on Zoom, we're still working on handling the moderation on Zoom, so we will get to your questions, but maybe after the show, because this will stay as a replay. So post your questions as a comment, and we will definitely reply. Okay. Alternatively, you can also email us questions at info@iflipinvest.com. Well, before we can get to any of that, we have to do everyone's favorite part, which is the disclosures and the disclaimer. So bear with me as I go through this with you. The disclaimer is iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip portfolios that you select are suitable for your investment profile before trading in a live brokerage account. Whew, that's always a mouthful. But with that being said, I'm going to pause the screen share now, if I can find the button for that, so that you can see our lovely faces. And I'm going to hand the floor over to you, Kelly.
Thank you, Aaron.
Yeah, lots of crazy stuff happened since our last meeting here. What do you got for us? What's the market?
Hello, everybody. First, we'll start with hello.
Yeah.
It's always how Jerry Maguire gotten by hello. I think during our last AI update, I came on, which was approximately a month ago. I can probably nail it down to the day. I think everybody who's repeating and on this webinar, as well as the previous one, remembered that I came out extremely bearish. That the market is has definitely difficulties ahead. A month later, that's proven to be deeply true. The S&P has dropped around in the area of 400 points for the S&P index. That's a lot. I think, Aaron, would you allow me to share the screen? I'd like to show a chart.
Oh, absolutely. Go ahead.
Let's do this one. And let's do this. Does everybody see it? Oh, cancel. Go up. Does everybody see that?
I don't think so. I don't see it.
Hold on. I think I have to hit OK.
There we go.
And then I have to hit. Now I don't see anything.
I see your desktop.
Okay, you see my desktop. Oh, good.
Yep.
Sorry, everybody, I'm a little slow. There we go. All right, I think this is pretty familiar to you. This is the S&P 500. I think we did one about a month ago. This is the spider. And I'm going to move this over here. And so I keep an eye on certain kinds of stocks and I try to view them against each other. And I think I came out right around here about a month ago and I pointed out we were bearish and we made this leg down. So again, to everybody over the next couple of months, and I will be doing these at least once a month on an ongoing basis, even though I remain bearish. As everybody knows, we have a scientific approach to the market. Our approach is mathematical. It's based on artificial intelligence and underlying algorithms. And so when you net that out, it's just a scientific approach. But it is kind of nice to know that behind the scenes, there is some understanding that fundamental data ultimately does drive markets. Science has to look at the fundamental data and interpret it to determine if it's time to buy things or sell things. What is the risk of things at any given moment? And I think if I were to ask a poll of the people out there, that I think the majority of people would say that going into the market right now is probably dangerous. I, for one, am one of those. The market, and this is the market, folks, the S&P 500 is what we consider the benchmark. I think that's what the world considers the benchmark for US equities. I'm going to go over just briefly some stocks to show you why I remain bearish. Well, first of all, the index, this is the pre-COVID highs. It's around February of 2020. We had what they call a V bottom. It went down and then it went up. I can scale this a little better so you can get it out of the volume area. It went down sharply. This was a 30%, 33% drop from that high up here to this tiny low down here where we closed. Flip did get long in this area here, and we rode it back up. It's one of those significant trades. And then, of course, the market, if you just look at the market, it went from the lows of COVID from 226 to as high at the end of last year. Notice that date, December 31 of 2021. It was the high. It went to 479.81. Call it 480. Again, the low was 220. It went to 480. That is over a 100% gain in the S&P in just under 2 years. I think that's remarkable. We have never seen that. That is unprecedented. Doubling of the stock market from low to high in less than 2 years. Well, I think what goes up must go down. I think most of us agree. I think the economics that occurred back in 2020 and it unfortunately occurred all through this rally where Federal Reserve kept interest rates at zero throughout this entire period. And to make matters better in the beginning, the US government, of course, pumped literally $13 trillion into the economy. The US economy is basically a $22 trillion economy before COVID. And now it got as high as a $26 trillion economy. However, now I think the chickens have come home to roost. And we have largely been absent from the market this year. Now, we also were not great big participants during 2021. The market had a 28% move to the upside. So if you were just long this symbol, you could have made 28%. That includes the dividend. However, it has given up, the S&P has given up 20% year to date. So basically, we've given up all of last year's gains, which we can go to about here. That's the end of 2021. Sorry, the beginning of 2021. So you can see we're very close to that. Just 30 points separates us from giving up all of the last year's gains. This is the best of the lot, because if we look at the NASDAQ, it's quite a bit worse. These are the triple Qs. And I'm just trying to set up a frame of reference, everybody, to how we manage things on a go-forward basis, because that's why we're all here today. So the NASDAQ pre-COVID was right around this area. We can see it at about 235. It went down to 167. Obviously, basically a 70-point loss off of 230. It lost again over 30%. However, look, from 168 low of COVID, it made its high a little around Thanksgiving of last year of 406. So think of these numbers, 166 to 406. That's 250%. What goes up must come down. From these highs here, and basically printed again at the end of December 31st, just like the S&P and the Dow Jones, meaningless index, we're down 33%. This index continues to struggle. Got a small little rally today, but this doesn't look like the beginning of a new move to the upside with this little rally. The NASDAQ is definitely extremely weak. I foresee the NASDAQ, and most of the people I know foresee the NASDAQ going down to the COVID lows. That is a full 70% retracement. So while the pundits on TV may be telling you to nibble, these are such great deals, I would ask them, what is the information they have to support that? Would they say it's because they're discounted 30% or 33% off of these high levels? That's not enough information for me. A discount is something that is more enduring than that. So a discount doesn't tell me that I should buy. What is the discount? I remember the NASDAQ correcting 90% in the early 2000s. At the turn of the century, there was the NASDAQ collapse. And I remember all the hype around it. Oh, we've mapped the human genome. It was like science was going to solve all things. However, there was a money grab at that time. Sadly, I see there's a money grab at this time. There was a difference though. At that time, we had reasonable interest rates around 4%, and we had no inflation. This time, we have extremely reasonable interest rates. However, we all know they're going higher. And we also know we have 8% inflation. I saw a pundit today say that he expects inflation to moderate down to 3% by year end. I, on the other hand, he was a very young man in his 40s, seemed pretty smart. I, on the other hand, remember when I came into the business in the early 1980s, they predicted the exact same things when it was at 8 in 1980, and it went to 19. It didn't subside, it went higher. Inflation is a very persistent thing. When prices go up, they're very sticky. They're reluctant to go down, even if they're incented to go down. In a rising interest rate environment, I have no idea where a person can say that he expects moderation. What I suspect is he is talking his book. His book is to hold on to his money for his clients and try to assuage their fears. I saw another very famous investor 2 days ago. Also, his name is Ken Fisher, generally very good, became apparently a billionaire creating his firm. However, he feels and has held on, he feels his technology stocks are good and he's holding on to them. And I feel this is a case where I think he's making a mistake, and yet he knows the history. So my bearishness stems, and this is again my rant in my book. Our book is we don't hold any positions in stocks. They're very dangerous to hold, except for a few sectors, and I think most of you know, it's the oil sectors. And if I just point at one, here we go. ExxonMobil, new highs. This was COVID, but we're way past COVID highs. And I don't think anybody's surprised. This is a market that I feel could go quite a bit higher still. But our science doesn't tell us necessarily to buy, but yet we are in some of these stocks in the red oil portfolio. So just everybody heads up. So if we just look index by index, I don't see any love coming in the market. Going back to the S&P, we see these little rallies, these sharp little rallies like we had about 10 days ago, only to be met with massive selling. We see it all the time. We see it trying to bounce off of a trend line I've drawn off of some of the lows. As a trader, I would predict that we would sell rallies. Every rally here has been sold, is worked out. New low, rally, not a new low, so therefore they rallied it, but then they really crushed it. Right here, new low, but a rally followed by sharp declines, which means you have sellers above the market. Here, a rally followed by sharp declines. Rallies, sharp declines, and then a sustained declines. That's the sign of a bear market. So this tells me that we may see this formation, particularly to me, looks bullish if I was a trader, telling you, hey, where do we go tomorrow? I would say we would open maybe a little bit higher, but we would fail sometime even during the day tomorrow or by Friday. So my stance on the market is bearish. Why? Well, we know interest rates are going up. So let's look at a 30-year bond future. Well, when the futures go down, that means that the interest rates are going up. This little rally here, well, we see it looks almost like a little head and shoulders bottom, but this rally is a relief rally because they see the stock market going down and it's a flight to safety. This market is very likely going to make continued new lows after a 40-year cyclical bull market. I'll get to questions pretty soon. Look at where it took us. Right into COVID. Look, this is COVID. Notice that the bonds rallied in COVID. Why? They knew the Fed would lower interest rates. But that was the high. And this may have, and I remember this formation, if we were able to go back to 1980, a very similar formation like this occurred the other way around when interest rates peaked in around 1980 June. That's when I think it occurred, because I kind of remember literally watching the market, and I was in my trials over at Solomon Brothers at the time. So to me, this market is also going lower, but it will rally periodically when the stocks go down too much for a flight to safety. So here we are here. So keeping this in mind, lower prices on bonds mean higher interest rates. This market here, I think, is going much lower as well. So if we just now finally just look at the energy prices, this is US oil. Basically, it's an index for crude oil. Very interesting thing about this chart, folks. See that little spike down here? That's when oil went negative in price. Look, something I'd never seen before. This is negative. That means they couldn't sustain the price. So this was probably the most unusual thing I ever saw. But if you look at this, this is a market that looks also like it wants to go higher. If this goes higher, Goldman Sachs, I heard, predicted 175. If it goes higher, energy costs go up, Exxon goes up, inflation goes up. It doesn't go down. It doesn't moderate. So I'm not talking anybody's book. I'm basically saying I see no chart patterns as a trader that look good to me. Other than this, this looks good to me. On the upside, I would bet long crude oil. I bet short bonds. I would be, let's look at gold. Let's talk about that. Folks, I don't see anything here. You know, normally we think when we see high inflation, we should see high gold prices. I don't see it. This would have occurred along in the 1980s, 79. I was coming out of school, I think, around 80. is I remember gold was spiking at $2,000 an ounce. Well, here we are 40 years later, and guess what? $2,000 an ounce, basically, a little less. Gold is no longer the proxy. Finally, well, let's not forget Bitcoin. Look what happened to Bitcoin. We see the correlation in the stock market. Pretty obvious. I think if I overlaid a chart here, if I add, there we go. And what chart? I won't do the overlay for now, just to make it easier for folks. I can tell you again, COVID, when the market went down, so did Bitcoin. Right in here, March 2020. But look what happened since. We made highs. We did our fall off. We made new highs here. This is the 60, almost the 70,000 we got to. And now we've fallen off about a little, just about a little more than half, 54%. But I'm seeing something in here. It's kind of trying to base, very similar to the stock market. We want to, you see this little base in here? What we want to do is look for this to decouple from the stock market. We want Bitcoin to move in a different direction than stocks for a while. So as it bases here, the real question is if the market goes lower and this doesn't, that'll tell you the signal to buy Bitcoin. So those are just some thoughts for the day. On the general overall market. So we've covered most of the things that matter. But I will also remind one last thing before we take some questions, everybody. If we look at some of these individual stocks that we all know, this is Bank of America. It got to 50, it's at 35. Well, 15, that's about 30% lower. We can also look at Walmart. Walmart completely went down to COVID pricing. It missed on earnings. This is the price it was during COVID. COVID was here, in this area. But it's here. Same, this is the 20th of March of COVID. It hit COVID pricing lows. If we look, another stock, I will say one thing, a couple of stocks I kind of like. I'm going to point out AT&T. I've never, generally I keep this in as a decorrelator in a portfolio, but we all know a while back, this stock, if we go to COVID pricing, we did see prices in about the 30 area, at 29 here. We're now at 21, but notice the movement of AT&T. We've been going down. It made new lows, but it pays a 5% dividend. It's here. This looks to me like a stock that could be resilient in the coming months under a different kind of environment. Finally, we have to look at stalwarts, and then we'll stop because I know my mouth is needing some water. Look at Apple. This is a stock everybody should always own, except when I look at the COVID pricing of 58, and I see that it has gone up from 58 COVID low to a 178 COVID high area, to me, that looks like it's gone up about 300%. It's down about 33% here. It went from approximately 180 to 140, so we're $40 off. So we're down about 24%. That seems like a discount, yes. But what if I were to say that it could go back down to 65? It would still be a great company. But if that goes to 65, we know it's going to take all the indices down because it's a big representation of all the indices, whether it's the S&P, the triple Q, or it's just the Dow. It is a representation of the market. And this is a very strong stock, but even with higher interest rates, it does change worldwide economies. And when I look at the outcome of high inflation, generally driven by energy pricing, a hawkish Federal Reserve, followed by no leadership in this country, at least, to be able to right the boat. I could probably add many more bullet points to say that the market should go lower. But I think the first three are critical ones. High inflation, higher interest rates, Fed is not calling for any kind of cuts, and no leadership. When I see three things like that, I really can't remember only one other time, and that was Jimmy Carter, no leadership, high inflation, and rising rates. The market did not have a good time for many years afterwards. So that being said, folks, cash is a great position. There will be opportunities that the science will follow to be able to try to buy the market. But I think we should remain and feel sanguine that most of us are sitting on cash while other people are holding their portfolios, hoping they go up, where we are just looking and hoping to find a situation to be long stocks at cheaper prices. So I'd rather be in the camp of strategically waiting and give up some of maybe some upside that will occur down the line than be in the side of hope and saying, well, they'll come back. And I don't want anybody that sits on our platform, folks, to be hiding like an ostrich and saying, I don't want to look at my statement. I'm afraid to see it. That's what I don't want. Because if we have that, then that throws out the meaning of the science that we use. So on that diatribe, sorry, folks, I am going to turn over the floor to some questions that I'm sure many of you have.
Absolutely. Thanks, Kelly. If you could also, if you're done with the screen share, if you could turn the screen share off so that we can.
How do I do that, Aaron? Remind me.
There should be a button on the bottom. It says stop share.
Here it is, stop share.
Okay, perfect. Okay, so yeah, as you already know how to do, if you've been here before, just type in your questions in the chat for Kelly. As you're doing that, I have one question for you, Kelly. You mentioned that prices are sticky when they go up. I like how you use that term. That really stuck with me, no pun intended. But what does it take in general to actually bring it back down to a reasonable rate, to bring prices back down, to bring interest rates back down to something that we're used to dealing with? It could take a long time, I'm sure, but what does it take?
It takes anger from the business sector to do it. I remember, again, at least in the past, when this occurred, I was a newbie on Wall Street. The person that gave it that term was Henry Kaufman. And Henry Kaufman was one of the CEOs. It was a managed company at Salomon. At the time, it was Henry Kaufman that led Salomon Brothers. And he pointed out the stickiness of inflation. When prices go up, they remain high, even if the underlying whole prices that they buy at, wholesalers buy at, go down. Prices tend to remain sticky on the high side.
Right.
And you would think of that if you're a lemonade stand and you're used to getting $2 a glass, but you realize your cost has gone down to 10 cents from $1, and people are still paying the $2. Why? And you look around and you look at your competition, like a gasoline stations. Very difficult for two gasoline stations on different sides of a corner to be able to say, I'm going to be a dime cheaper.
Mm-hmm.
They want to keep their prices about the same in their local events or similar fungible products. So what it took was the anger towards the government, which was at that time Paul Volcker, for raising interest rates so high that it made it impossible for businesses to borrow. Businesses borrow on something called the prime rate. Prime rate is set by a bank based on the Fed funds rate. Well, the Fed funds rate was 20%. That's the short-term interest rate. So therefore, they offered to a company to borrow at Fed funds, 20%. No business can borrow at 20%. They
Right.
can't borrow. So therefore, there's no way to expand, no way to improve, no way to do anything. They're just stagnant. And so there was huge complaints at that time about the business that a lot finally started to get, and the stock market started to recover. It took until June of 1982. I kind of remember the moment the Dow Jones rallied $35. That was just $35, the biggest day it had ever had. And that set off the largest bull, literally secular market that brings us to where we are today. Because remember, the 70s, we didn't move anything. So it's going to take anger and a lot more pain for people to start complaining that interest rates are too high and we can't grow. I think right now people are too complacent. They think, oh, it's going to come down. This is going to be temporary. Remember, the Fed thought it was temporary not too many months ago. Now they realize it's here and it's already at 8%. It's not at 3% or 3.5% or 4%. It's at 8%.
And how long does that kind of cycle usually take, right? Because you're saying people need to get angry, and that happens usually over time when they can't take it anymore.
Yeah, it won't break the inflation cycle for about 8 years, but inflation will come lower as soon as we see meaningful action to combat it. Meaningful action is raising the rates. But there's other things on the fiscal side, in other words, what the government can do to also do it. The biggest thing I think everybody realizes the government could do is to do things to bring back at least energy costs to the consumer. So we have another new problem too. You might notice, everybody, the spread between diesel fuel, which is how we move things around the country in a truck, and regular gas is over about $1 in most places. That's a significant difference. So if you're in Arizona, we pay $4.79 for gas right now. Diesel I am seeing at $5.69. So 90 cents difference. That's very difficult on transporting things in and out of a grocery store or a Home Depot or a Walmart. That has an effect. And until we solve that problem, we're going to have troubles. And I see no effort as of now to do that. So I can't understand why anybody would say we see a chance that inflation will be abate down to 3%. It makes no sense at all to me. It means cash, folks, are a king. You want to hold cash.
Gotcha. Okay. So based on what you just said, I mean, I guess it seems like we can expect to, unless anything drastic happens, we can expect to see that downtrend kind of continue at least for the rest of this year, maybe more, right? If a standard cycle takes around 8 years for people to clamor to get the rates back up.
Yeah, remember, the market will recover before that.
Gotcha. Okay.
But we're going to be battling inflation and its after effects for up to 8 years into the next presidency. And I remember, because I was here and I came onto the street literally at the time when inflation was peaking. I had no idea what that really meant when you're 20 years old, 21 years old I was, 21. I had no idea what that really meant. Now I do. And I'm a person that remembers it. I saw it, and I remember the responses. I remember the markets with a very keen eye. Even though my whole career was spent scientifically, I still walked around and talked to the people that actually made these kind of larger decisions that at that time could affect the global economy, or at least the domestic economy. Because, for example, one of the board members for Salomon Brothers was Henry Kissinger at that time. And I actually attended some meetings with Henry Kissinger in the room. I'm 21. I was in the back, I'll admit it. But there was a lot to be said at that time about the outlook for inflation, the outlook for how prices in different sectors mattered and where they had to focus things. And some of those things came from higher powers from the administration at that time. In 1980, it was still the end of the Carter administration. when Reagan took control in January of 1980. But I remember, actually, it was the beginning of the Reagan administration, and there was a lot of policy changing going on to correct the issues that occurred during the Carter administration. So this is a time, folks, where the only thing coming out of my mouth is at least being matched by the science of our platform, is to stay out of the market. And I think we'll be happier as the months come if the market is lower and we realize we've sidestepped that this is how you can beat the market. You need the market to go down so you can reposition cheaper.
Right.
And the market will not go down forever. It could go down, though, for a year. So don't worry about saying, well, what about I don't make any money for a year? Well, at least you don't lose it. And so it's like, oh, if I sell it, I'm going to have a capital gains. Well, I pay the capital gains rather than lose. What's my capital gains? 20%. If the market goes down 25%, I've already saved. I'm going to buy it cheaper.
On that note, Kelly, maybe you can shed some light on us, because at the end of 2021, when we were doing a recap in January of 2022, we had to say, hey, 2021 was a year that we were humbled, right? And we somewhat underperformed because the S&P had a meteoric, skyrocketing kind of return at 28%, and we didn't. But now, have we evened up the score by staying out of the market?
Yes.
How can we compare ourselves to
last year? We were up about 18 on the S&P for our systematic scientific approach. The market itself was up 28. It beat us by 10.
Mm-hmm.
This year we're down about 4 in the market, 4.5 area on the S&P. Mm-hmm. That's our benchmark model, folks. The thing is, like, we just trade the S&P, and the S&P is down about 20. So we've made up 15%. Now, that means, yes, we've recovered on a long-term basis over 2 years, or actually not even 2 years, over the last year, plus these 5 months of this year, 17 months, we're ahead over a rolling 17-month period. And that's what I care about, rolling. I don't care about the end of the year. I care about rolling periods.
Right.
So when you think of it this way, if this market does what I suspect and what the science is so far saying as well, and goes down, say, another 20% from here, that means it's basically on the S&P, we're talking about a correction that looks around 35 to 40%. I know that sounds enormous, but if you really think of the content of it, given what's in front of us, that's nothing. In which case, that's another 20%. That means we would really outperform the market. And I can tell you then, the science will look to buy it. I just know, because the way of the information that I send into it is designed to look at interest rate changes and fundamental data of companies and of global macro events. Things, again, I think I mentioned it, things from credit card defaults to credit card expansion to the amount of M3 in the economy. M3 is a measurement of the type of money in the economy. There's M1, 2, and 3. M1 is cash. M2 is cash and credit in bank accounts. M3 is credit, cash, bank accounts, brokerage accounts, and also bankers' acceptance monies that are international flows. In other words, money pledged in the economy, things that we never see. But it's the bigger transactions, the billion-dollar transactions that go on around all countries all the time. So I look at that expansion. When that expansion generally switches, then you'll also see rallies or declines in the market. M1 is the most obvious one because that's just cash. Right. And what the Fed is doing now is literally taking cash out of the system. And when they take cash out, there's less liquidity, less dollars to chase things to create inflation. That's what they're doing now by raising rates. Gotcha.
And that's their way of curbing the onslaught.
One of the ways they can. They have other tools, as they would say, in the shed. but the main one is rates. There's others, and I'll mention just one. They can change the reserve requirement. That's the amount of money they tell the banks that they must keep in cash in order to satisfy any run on a bank. Or if they keep it in cash, that means the bank can't lend it. They can't lend as much on their free cash.
Right.
And if they can't lend it, that means guess what they're doing? They're pulling cash out of the system.
Right.
Through the major banks, JP Morgan, Bank of America, Wells Fargo. That's how they do it. And they have other tools as well.
Gotcha. Well, I feel like today was a big lesson on macroeconomics and it was specifically interest rates and inflation, which is always important, really important to at least be aware that these macroeconomic principles are governing the markets and influencing the direction that they go, right? So that we're not surprised. You don't have to become the next, economist or anything like that. But it's nice to know that we have these resources like Kelly sharing with us that can make it digestible for what's happening in our own portfolios. Right. So thank you, Kelly, for that. I don't see any questions. I hope that the chat does seem to be functioning properly. I don't see any questions, but I'll give you guys a few more minutes to get in anything last minute while I talk about a couple of product updates, and this won't be very long at all. So get in your questions quick if you have any. So I know that a lot of you have been eagerly anticipating the release of crypto trading functionality on the iFlip software, which is something that I came on this AI circle and said that, hey, from a technical perspective, software perspective, iFlip is ready to do it. And that was back in April, and now it's almost the end of May. So what happened, right? And the short answer is legal red tape. If I can make it as simple, simplified into 3 words: legal red tape. Basically, without getting into too many of the details, because we'd be here forever, the crypto, I guess, supplier, if you will, it's not the technical term, but the company that supplies the crypto for us to be able to trade with Velox, they require a strict, as they should, they require a strict level of AML, which is anti-money laundering regulation and verification type stuff with their documents, which is good, right? Crypto is known to have funded some naughty behavior in the past, right? And so they want to make sure that everything is above board. That process with Velox, completely outside of what iFlip was involved in, because we're just a software company that is helping you execute the trade conveniently. The Velox and Paxos have gone back and forth, and they're still working things out. And they've had to, I'm told that they're on the last phase of that. They have one last checkbox that needs to be ticked off before we're ready to go live. So we've been standing by for a good 6 weeks, and I know it's frustrating. And I thought this entire time, personally, I'm the product manager, right? So it's like I'm responsible for this, and I thought this entire time we were going to be like iFlip, my team was going to be the bottleneck in delivering this to all of you, our customers. But it actually turns out it's the red tape, and it's something that I didn't foresee either. So apologies for the inconvenience, but we thank you for your patience. Most of you have been very, very understanding. And honestly, look, we just talked about this. The market is, you don't want to be a buyer in this market anyway, right? So you're not really missing out much.
It was very fortunate because generally most people, when they go into crypto, they buy it. Mm-hmm. And we now know crypto is sitting at its lows. So if I had to plan it, I couldn't have planned it any better.
Yeah.
And that's also, Aaron, you might want to mention that's one of the reasons why we're leaving TradePro and going to Zinvest, is because we can't trade crypto with TradePro. So we had to move over, and that was it. TradePro just doesn't want to go there.
Yeah, no, absolutely. Thanks for bringing that up, Kelly. I wasn't going to get into details like that, but since you brought it up, one of the reasons I said it was actually going to make things easier for us and consolidate is because, yeah, TradePro wasn't going to deal with crypto, and we were going to be forced to deal with Zenvest. So if we hadn't moved on from crypto, you would have had to deal with documents from both TradePro for stocks and Zenvest for crypto. That's extra work on your end as well. So that's why I mentioned that it's actually an improvement. They didn't phrase it quite that way in their email, so again, apologize for the confusion there. But that is the reality of what's happening. Instead of two sets of documents dealing with two different companies, you're really just dealing with the one. And crypto is a huge component of that. We did get a question, so we can finish off with Juan Dominguez, who writes in. I thought the SPY was bought by the AI a few days ago. Kelly sent out an email indicating that transaction. Is it fair to say that in the short term, the market will bounce back, although Kelly remains a bear? Kelly, what do you say to that?
Yeah, the SPY was not purchased recently. It was a few other stocks were purchased as well, but they quickly got out. That was an algorithmic trade that occurred on some of your accounts. It was an attempt to buy. It was actually the same trade that was put on during the COVID lows and the 2018 lows, and it was triggered. The 2018 December Christmas lows that we had from the trade war. Same trade occurred, not in the SPY, but for example, in Apple or some stocks like that, it occurred, but it quickly got out. It was literally an algorithmic trade that ultimately got overrode by the AI literally 2 days later, which was, very unusual, but it made sense. So yes, that occurred. And what was the second half of the question, Aaron?
Is it fair to say that in the short term, the market will bounce back, although Kelly remains a bear?
I'm not so sure it's going to, the formation looks like, hey, it's something you could buy, but my book in my mind is too set to say, why would I look to try to participate in a buy here, even if it's correct for the short term, when I realize that this is a case where the market to me looks in the long term to be much more vulnerable to higher interest rates and high inflation. So those are not the things I want to buy into. Essentially, if I buy the market now, I'm fighting the Fed. And it's completely a technical trade like a trader does. And for us, the people on the Flip platform, we're looking at this as an investor. How do we take advantage of these lower prices and find better ways in better places where there's much better risk reward opportunities down the line? And right now, AI doesn't see it. It just doesn't see it. So yes, I kind of think maybe it could bounce a little bit. Big deal. I think the general direction has been established to be lower. So it's a riskier trade to go long right now.
Yeah, I've been, a user of the software for almost since the very beginning. And so I remember each one of those little buys that you're talking about, Kelly, on my own account. I'm a product of the product. And the AI, I've noticed that the AI, Juan, hopefully this helps. It's AI algorithms. Yes, it's computerized and mathematical, and human emotion is not a factor, but it's not perfect. So it'll take a shot. It'll take the statistical edge, and it'll take a shot, but it'll also very quickly be like, "Oh, that was wrong," and get out. That's where most human traders, even the best traders, get kind of like emotional and be like, "No, I want to be right about this," and maybe hope can set in, and things can compound out of control. That's where AI really is a helpful tool.
Yeah, I'll add one more thing since we have a few minutes more left.
Sure.
Again, think of this, everybody, folks. Generally, in the long run, the market goes up 85% of the time. But when it goes down the other 15% of the time, it doesn't go down with symmetry. So it's not symmetric. It's called an asymmetric return. When markets go down, they go down very quickly and sharply. When they go up generally very slowly with very little slope. So when they go up like they did in 2021, that's where flip will fall behind periodically. But when they go down sharply. That's where flip will excel. And they always go down.
Mhm.
They always go down. There will be a reason. The world is not perfect. If it was perfect, we could design it to go up in a different way. But no, it is part of our emotional process to be able to buy and sell, because we have the old things, fear and greed. I won't go into it. I think a scientific approach is really the best way to go. And I also want to note to everybody, tell me one person that you've ever seen on CNBC or Fox Business News that ever comes up and is a pundit about the science of the market. None. There are always people that have a book, some advisor that has a couple of $100 million under management who is saying, this is what I think is good. I stick to this and this. This is where I think the market is going. What do you think? Well, there's hundreds of them, and they're just as good, no better, no worse than all of us. I'm always going to science. I'm going to be on the team of the MIT poker players over at the casinos rather than some guy going in there with a few beers playing poker. I'm not that guy. So you have to count your cards, play it like it's science is a much better way to invest in the markets. And yes, if the market goes down 40% and we chip away and lose a percent or two here and there, trying to find a reasonable buy, it's worth it. And that's exactly what you should expect in the future. We probably will, the science will say at some point to buy it again and try. But when our stops get hit, we got to get out. It's all there is to it. It's the market violates some of these buys. It violated very quickly the other day. So that's just part of the business. It's a good part because you got to play periodically too. We must be in the market, but we want to play when we got a good hand, not when we have a hand where you see it's kind of stacked against you. So that's a thought too. I just want you to have that thought, everybody.
Thanks. And Kelly, can you squeeze in one last question real quick?
Sure.
Sonia Malani, hopefully I'm saying your name correctly, asks, how long do you think the bear market may last? Years? Is it possible that Bitcoin may replace gold?
Okay, I see the question. I do think that the bear market, until we see some change, is here to stay. So it's only been around since the beginning of the year. We can count it. We saw on the chart I showed earlier that the market peaked literally December 31st of last year. Interesting, isn't it, folks? But I think the market will literally go down into the election. So we don't ever want to say how long it can last. I can tell you that I wouldn't be a buyer of the market until the election is over. That might spawn something if there's some kind of secular change in people's perception that a new government, at least on the congressional side, may be able to affect some change. So for now, I say it's until November. So I'll leave it at that. And by the way, will Bitcoin replace gold? Yes, I think at some point it will decouple from the stock market like gold has. And when it does, that's when you know gold is over. Gold is sadly, my grandfather. No, I'm not a grandfather, but I got friends that are. It's our grandfather's hedge. And I think gold is a dead horse. Don't buy it. I don't think it's going to protect anybody. We know Bitcoin hasn't done that either. The protection is really being in cash. I do see a bright future for Bitcoin though. I feel that's very obvious. It doesn't mean you just go out and buy it, especially now, but I think it will ultimately be the anti-hedge of the future as gold was in the past.
And what should you do with gold if you have some? Not that we're not giving advice. I just want to really reiterate that.
I would sell it because when the end of the day, it's maybe got a couple of $100 up and maybe a couple of, I think maybe more down, maybe down to 1,000 again. I don't see, even at a height of much greater inflation, that gold is going to be the the hedge that we all think it should be. I think it's past.
Yeah,
We're
I
beyond
don't think
that.
I don't think anybody would disagree that Bitcoin, in general, Bitcoin is way more interesting of a hedge than gold is, right? Just even ask the most non-sophisticated crypto holder or gold investor that there is, and that Bitcoin seems to be way more interesting. Crypto in general seems to be way more interesting, and that's where attention, what you focus on, will expand, right? And so yes, I tend to agree with Kelly on that. That's it for our show this evening. Thank you very much.
Thanks, everybody.
As you may know, we are on YouTube as well. So I'm going to provide everybody the link to like and subscribe on YouTube to the iFlip YouTube channel. Eventually, the Zoom registration will be phased out and will be exclusively on YouTube. We're streaming live on YouTube, so we'll be engaging with you there. But that is a slow transition process. We're still going to keep it the way that you guys are used to for the time being. And but please go head on over to the link there. Like like this video, like the stream, subscribe to our channel, and turn the notifications on, because that will qualify you for a lot of the giveaways that are going to be coming up in the future. So keep an eye on your email for that kind of notification as well. Okay, with that, again, thank you for joining us this evening.